Perfect.
All right, very good. We'll start over again. Again, I'm the rookie. Uh, I am the program manager at MTech Ventures. This is the part of the University of Maryland, Maryland Technology Enterprise Institute, which is part of the School of Engineering. And our job is to support young companies as they come out of the university. I'm joined here by my colleague, Ala McCoy, and she is the Director of Startup Support also here at the university, the UM Ventures office. We work super close together, and we're happy to do this. I'd like to extend a warm welcome to everyone who's joining for this installment of Startup Fundamentals Workshop. We love to have you join us, and we will be recording this, and we will make it available on our YouTube channel, and it'll be there and we often get many people viewing those on the YouTube channel. The workshop series is offered both by UM Ventures and MTech here at the university. And for those joining our live session, feel free to submit questions using the Q&A function. You can also find that at the bottom of your screen. Questions always make the sessions more interesting and relevant for you and the topics that are important to you. As a reminder, we're recorded. We've talked about that. And today's discussion, and last thing to bring up as we get started is we're joined by two of our friends from Western Alliance Bank, Brian McCabe and Tony Badia. I met Tony in person a couple of times at the Big Ten Ventures Network meeting. So Tony is real. I've seen him. I've shook his hand. He's real in person. Brian, I'm not sure about yet, but we're going to have a great conversation about where debt fits in about where venture debt fits in the capital stack and what's important to you as a young company and how to think about this. Uh, Tony said something to me the other day, which I really liked in the way of thinking about this and about Western Alliance Bank, which is think about what a bank can do besides just be a bank account. And I really like that. So with that said, I want to get started. I want to introduce Tony to get started, and I'll press the button and we'll share our slides.
Okay, great. Well, good morning and good afternoon, everybody. As Rob mentioned, my name's Tony Padilla. I'm calling in from San Francisco, but it was great meeting Rob and Ala last year at the Ten Summit that we hosted. And we spoke high level about ways to engage and collaborate and add value to all of the founders and startups coming out of University of Maryland. And we're just delighted to be doing this and putting this to action. So I'm joined here by my team member, Brian McCabe, and we're really thrilled and excited to share, what we do to support startups in the innovation community, and how we support founders throughout each stage of the journey. So a little bit of quick background about Western Alliance Bank. We are one of the largest regional banks here in the US. We're 98 billion in assets. We actually just reported earnings last week. So very close to crossing the 100 billion threshold. We're headquartered in Phoenix, Arizona, started in 1994. We've been supporting the innovation and startup and venture community since the early 2000s, through a division of Western Alliance, which was known as Bridge Bank. Some of you may have heard of Bridge Bank before. It was the tech and venture division under our parent company, which was Western Alliance. And there's more that Western Alliance does beyond tech and venture. We're also very active in like the commercial real estate space and HOA banking and hotel finance. But Bridge Bank was the innovation and venture arm under Western Alliance. And last year, as we approach to become a Category 4 and large financial institution bank, which is when you cross 100 billion in assets, we decided to go through a brand unity process to have one identity in the market. So we're now the Western Alliance Innovation Team. But yes, we're excited to share all the value that we bring in to support early stage founders. I support a little bit more on the pre-seed and seed stage size of companies, where Brian and his team support companies that are approaching that Series A level and beyond. So I'll kind of turn it into Brian so we can get started here.
Yeah, hey everyone. So Brian McCabe.
Maybe next slide, by the way, Rob.
Yeah, next slide. So I run the tech and innovation team for the Mid-Atlantic and Southeast. For us, that is Philadelphia down to Florida, having people in Philadelphia, the DC area, North Carolina, and Atlanta. So pretty spread out from a footprint. Just given the market, this is it's it's better equipped venture debt, and we can go into it more where you have people, boots on the ground in specific regions. So we try to have people in a lot of our hubs. So I've been here at Western Alliance for 10 years and previously was at Capital Source on the portfolio side for a sponsor, also tech and healthcare buyouts. So have been in tech lending for close to 20 years now, just through different avenues. So happy to go through the agenda and to the point. I'll try to answer questions in the webinar chat if they come up, but we'll leave some time at the end of the presentation to go into more in-depth questions.
Great. Yes, and then as I mentioned, I'm part of the earlier stage startup team here at the bank. So I work closely with founders that are just starting a company for the first time, or maybe some repeat founders. But really, my goal is to find ways to add value as a bank partner to the companies that we're working with. So we want to help with all the banking elements, but also go beyond that of understanding, what helps you now? Is it meeting other founders? Is it getting people to pilot, your product or, just other types of traction? A lot of times we work to support our founders through strategic introductions, through our angel and VC network as well. So I just find the most value from helping founders in the early stages and seeing them grow and progress. And I'm sure Ala and Rob have the same feeling, seeing some of the portfolio companies grow and reach new horizons. So delighted to be here and find ways to add value to all of you. Okay, maybe next slide.
So we try to break down the agenda into pretty much four sections. First, what is venture debt? When does it make sense? When does it make sense is a very important question. If you think about debt, it sets a time clock. And so when is the right time to set that time clock is going to be very important. Benefits to founders and the company, right? And we'll go through where we see benefit, where we see perhaps there is not a benefit. One of the big things we say is venture debt's not for everyone, right? And there's all different kind of flavors of venture debt. There's not a lot of banks who provide venture debt, but the ones who do, we're under very similar guidelines. So just kind of navigating all the different avenues for venture debt. What banks look for, we'll walk through initially when we take calls. We're taking calls from early stage companies to IPO companies, pre-IPO companies. We do provide some pre-IPO debt to several companies, especially in COVID. We were seeing that a lot. And then kind of what is a venture debt process. And then we'll also leave time also to Tony's point around kind of startup banking needs. There's a very different kind of bank, Western Alliance, where we dedicate a lot of our time to startup founders and early stage companies. What we find a lot of value there versus maybe some of our competitors who don't have venture debt practices. And so some of the pluses of coming over to us around not just debt, but also banking. So we'll go to the next slide for venture debt overview. So venture debt, typically founders are looking at capital, looking at runway, right? This typically where you see venture debt is it's complementing venture equity rounds. And so we're seeing predominantly venture debt makes sense for companies that are raising an A. Seeds have gotten larger, right? And so we do have some companies in our portfolio, pre-revenue seed rounds who are raising venture debt. There are opportunities there. The way I look at it, even all the way to IPO and public companies and BCD, right? There's still companies that, for whatever reason, want to extend runway, right? we typically say the later you go, probably the farther we can get in between rounds. We are more underwriting the company versus early stage companies. Early stage companies, we're really underwriting the VC, the kind of product market fit thesis and management. That's very important. The later you go, the more you can underwrite the business. You have recurring revenue. Um, you have scale. And so there are metrics tied to that, KPIs that are tied to that. Loan to value to customer acquisition cost is a very important one there that we look at. We can go more into in the future slides, but that's more where you can see a repeatable business and can get in between rounds, I would say. And then obviously companies are raising equity, right? And so predominantly we have a lot of connections with early stage VCs across the nation. Me specifically, we work a lot with the Mid-Atlantic and Southeast investors, just given that's kind of where our footprint is. And so we are trying to do events with them and bringing in companies and the VCs, trying to match them up. We go to conferences to be supportive of kind of the regions we're in. And that's where we're seeing a lot of kind of business. But for the most part, it's designed to extend runway, right? And so to the point, when does it make sense for venture debt? It's you've proven product market fit, and this is being used to extend that runway. So if you kind of think about how venture debt works, right? It's runway extension to the next round. And so what we're typically talking to companies about is they have certain amount of runway. You'll hear it even, you're seeing it more in the private credit market. There's enough capital for probably kind of plus or minus 9 to 12 months of runway on the balance sheet today. Venture debt has helped extend past that. If there's a lot of founders on this call, as you know, the model you have on the go forward is very hard to predict, right? There's a lot of, you can even say macroeconomic um, situations that you can't control, right? And so the more you can have flexibility and have that flexibility covered with debt versus equity, the less dilutive it can be. It will be. And the more you can continue to kind of grow your top line, because a lot of companies are valued off of the top line, right? And so the more you can do that with non-dilutive capital, the better it is from a future dilution as well when you go out to the next round. And so a little preview of that, how it benefits founders, right? It's all about dilution for the most part, right? It's how can you get you're trying to balance runway with and with a safety net. And so it is there is no right answer, right? You can talk to investors, some who say they love debt, some who say they hate debt, and some who say it's used at the right time. We believe you use it at the right time, because it's debt, right? Going back to what is venture debt, you are you are effectively putting a timeline on yourself, right? Because how venture debt is typically works is it's a period of interest only. So no amortization. You're paying somewhere, depending on bank debt's kind of close to kind of the 6-7%, right? Interest rate. You'll see non-banks get up to probably around 14%, but there's no amortization for anywhere between 12 to 24 months. But usually when it starts, how it's typically different than what you might see from your kind of standard commercial and industrial loans is that those loans have larger bullet payments at the end, so low amortization. Venture debt has pretty heavy amortization after the 12 or 24 months. So if you don't have the product market fit or you don't have high degree of confidence on execution, by 12 to 24 months, that is a lot of cash that is coming up due each month, right? And so that's where you'll hear from a lot of investors. where they'll be a little cautious on venture debt because of that timeline. Now, we say that, but I have a client here that's been here since 2017, another one 2018. It was actually when I was an underwriter, so a portfolio manager on those deals, right? And so they've been clients for, almost 10 years. And so one of the things we always say about venture debt is if we're not touching it within a year, then it's unusual. And because typically what's happening is a company is either beaten plan or not hitting plan, and there needs to be an adjustment to the deal. And so one of the things we go through is the runway. What is runway? What is performance? Maybe you're not growing 100%, but are you growing 30%? And so do we have the appropriate amount of leverage there? Is there a need for investors to put some more capital in? And so there's a bunch of different questions we want to kind of go through with the company and investors. But to the point, excuse me, to the point, we have a lot of long-standing companies. Our best scenario is we get in with you early, pre-revenue, and then we're there past IPO, right? And so for those, right, we can see we have a bunch of examples where we go from $1 million loan to a $50 million loan, right? And it's because to what Tony said, we're almost $100 billion bank. We have the balance sheet to grow with our companies. It's actually one of the reasons why Bridge Bank merged into Western Alliance about 10, 11 years ago, is we needed what was happening in the market back then was there just wasn't a lot of IPOs in the market. So we were seeing more D rounds than you were previously. And so having a bigger balance sheet was very important for us as a bank. For Western Alliance, a national footprint was very important as well. And so it was actually a really good marriage between the two banks. And it's been very successful. And so here, sorry, snooze something. So where's our money typically going, right? Companies are typically hiring, right? Go to market people, still some kind of R&D spend. You're seeing the top line traction. What we're seeing a lot too now, right? We're seeing a big shift back in the market to hardware. So there is a lot of upfront payment for some of these hardware companies. And so venture debt, a lot of the mentality we're seeing from these companies is, hey, look, I raise equity to grow. I want essentially equipment line or working capital line for a lot of these upfront purchases. We're seeing venture debt come up a lot more for that kind of business model versus the, probably 8 years ago, a little more kind of your subscription models. And so that's where we're seeing value for companies for venture debt. And so again, really focused on runway extension and hidden fuel and further top line growth have been differentiators for this, for where venture debt makes sense. And so benefits to the company, right? It's the same thing pretty much as the founders, right? The more you have available for employees to provide stock compensation, the better for retention, right? The more you can hire people, both on R&D, sales and marketing, right? And so we're seeing that as always been a big part of kind of what we do, reduce costs of capital as an alternative to equity, even from the difference between bank debt and private credit debt. The big thing there, right, is cost of capital. Our cost of capital as a bank is lower because we are able to use our commercial deposits to fund growth. And so in those scenarios, right, our cost of capital is lower than private credit. Usually they're using equity to fund, and equity has assumptions on returns. Now, still there's value where we see companies maybe mixing us both. So there are scenarios where it's more on growth stage companies than early stage, but we we'll partner with some private credit from a perspective of, hey, look, leverage profile is a little bit higher than what we would want to be as a bank. We are a regulated institution, and so there are guides we give ourselves and policy we all give ourselves where we need to be a little lower leverage than maybe a private credit. And so, but with us plus private credit, the cost of capital in a blended mix is very attractive for a company, but still kind of get the amount of leverage you were kind of hoping for. And then just demonstrates confidence, right? Even there's a couple companies we're talking about that have about 2 years runway on the balance sheet. They're going to the market for an IPO. It's nice to have on an S1, a bank credit facility, even if it's unfunded. We actually, if I look back in COVID, our utilization rate on facilities was probably 20%, right? Because a lot of times we have lines of credit. And so pretty low utilization rate. But a company going into doing their roadshow with uncertainty in COVID, company was still performing, wanted to boost up the balance sheet, wanted to show that they had a bank facility in place as they went, fully drew on the line, had ample liquidity to go through the roadshow while continuing to invest in top line. And that was one of the earlier companies to kind of go to tech companies that in COVID raised money in an IPO. So it was a super successful stayed a client of ours until taken private on a bigger merger. So great company, great show of having that liquidity and having that demonstrate confidence when they went out to the market. So credit evaluation, there was actually typically our process is either me or someone on my team or even Tony, right? We're getting an initial call, right? Of, hey, does venture debt make sense? And what's nice about venture debt, we always say it's like a snowflake. Every deal is different. So until that initial call, what we try to do is talk with the company and understand their needs. And if we fit, and sometimes if we don't fit, we will say, hey, look, this might be a good place for some of these private credit investors who we know well that might fit you better there. But here is our, banking solutions that you can use that are going to be cost effective. And when you're ready, the venture debt team will be there for you to look at the opportunity. You'll have a point of contact on the venture debt side to go through that opportunity. We do sometimes say, look, I don't think you're going to meet the private credit box. And so where you need to be cautious in those situations is around, maybe debt facilities that are more expensive than equity, in the concept of you're paying a really high yield and you're having to pay it back, right? So if someone says, hey, look, I'm getting these great terms, can you match them? And we walk through those terms. Sometimes once you go through it's 15% interest rate with a heavy back end fee, and then immediately starts to amortize. So no interest only period. And so if you look at those, the effective cost of that loan is actually really high. It gets closer to like 30-40% return for the lender. Those and immediately amortizes for early stage companies. That is tough debt to service, I would say, right? And then it puts you into this cycle where instead of investing in sales and marketing, in R&D, you're constantly looking to have to refinance existing debt. And for an early stage company, that's hard hole to get yourself out of. So sometimes where we come in and say, hey, I think you should wait till this point in time for debt. What we're still, again, happy to loop in Tony to start building up a startup banking offering for you. But it might not be a good fit for you today. And so, what I always say on those initial calls, it's when we kind of set the tone of what we're going to try to do for you, but also where the company fits. And so there was actually Y Combinator, and I actually just reposted it just because I thought it was a really good um, post on being truthful and precise about revenue, right? Because you're not just selling the business. Part of our credit underwrite is the CEO and the later stage companies, the CFOs too. And so they had this great post again. I reposted it, so I won't go too much into it, but things like they talk about when you're selling revenue, is it a pilot? Is it an LOI? Do you call that revenue versus being upfront and saying, I have a customer signed in a pilot, plan to have them under a longer term contract by this date. The other ones we always hear that I think cause a little bit pause is when someone gives a high revenue number. And once you go through the layers of that and you find out it's something like gross merchandise value, right? And so it's really overstating kind of versus you saying we have a GMV of this, our take rate is 20%, 30%, 10%. And so our net revenue is this. I think that's very important because, right, this is your first meet. And so being upfront and being honest and being precise is very important. Um, Even, bookings, car, right? So contracted ARR for companies that don't really know when is this revenue going to turn into recurring revenue? What are the milestones for that contract to hit to recognize revenue? As well as, just pure, this is our ARR today. That is something I would be very precise on, especially, I mean, this is also for anyone here looking to talk with early stage investors, right? They are constantly getting pinged. And so they want to hear precise, right? Because they'll be honest, they'll tell you where they sit. But if they find they have to go an extra layer to get to that what is revenue, that might knock you out of the run-in of all the companies they're seeing. And then again, just the difference, another simple one. What is the difference between annual revenue, monthly revenue, and total contract value, right? Total contract is typically if it's 3 years revenue, that is, you need to give your ARR, your annual number, be very upfront and honest there, right? And so those calls we try to have anywhere between 30 minutes an hour. And if we see this check the box, what we do is we loop in our underwriting team. And so our underwriting team and actually our portfolio team is one team. And it goes back to one of the earlier points I made. We're typically touching a deal every year with some kind of amendment, some increase, some modification. And so we like to pretty much centralize the team so that we're meeting client needs, right? This is why also Tony and I are connected so tightly and so closely is we're one bank. And so uh, having a single source of point of contact is super, super important for earlier stage companies. I would say probably 90% of our deals are spending more cash than they have, right? And so in those scenarios, you need to be on top of your portfolio. You need to be on top of your clients' needs, so that we're locks that together in what is runway, what is burn rate, and kind of what is revenue visibility. Um, to the point, we are because these are investor dependent or enterprise value dependent loans, majority of them have an investor we've done business with before, repeatable investor business. Now, the only way you gain more relationship is we do have deals where we are looking at where we want to build those relationships with those investors. And so, really the strength, reputation, and support from those VCs is crucial in our underwrite. Now we do have more of a investor asset-based lending group as well, where we can be doing deals that might not fit kind of the enterprise value bucket, but have really good collateral, really good performance. We'll loop in an asset-based line to look at it. But like I said in the beginning of this, not every deal's the same. So we try to make sure we look at everyone uniquely. It's important that we're understanding the business model, understanding the client or the prospect's needs, and working with them on that. So how to start a process? Many different ways. I think being on this call is a great way to start the process. Working with University of Maryland, right? They have companies that, are like go from ideas to generating revenue. Uh, they're there to help you figure out the debt process, right? Um, and so that's one avenue. The other avenue I would say is, we get reached out to online. We set up calls. It'll either be with me or one of my relationship managers to go through the opportunity. And again, what we try to do is, even if it's not a fit today, we see if there is a fit. We try to give helpful insight. Sometimes, one of the things we try to add value for investors too. So we get calls of, can you help me find, a seed stage investor or an A stage investor? Given we have contacts at those places, we typically ask for an investor deck and share it through our network. Yeah. Again, with Tony, that's part of our startup banking um, product enhancements, right? Is part, we want to offer people startup banking and connect them with networks, connect them with product solutions we have so that you can grow here with us. And so we're going to be your big cheerleaders as startup banking clients. And then, I would say probably 75% of the deals we see are coming through the VC, institution VC. They'll put together a process, typically anywhere between two at a minimum, probably to kind of four banks. They'll kind of loop in to look at a product. I will say we're probably top two in the space. So we're majority of the time a company is raising, they're coming to us for venture debt. The other place we get, and not so much on early stage, but later stage CFOs. We typically see someone hire kind of VP of finance or CFO or right after a Series A. Depending on the A, we'll see a fractional CFO for the most part, kind of help clean up the numbers, make sure you're showing things in GAAP, and then helping you kind of run a process. So that's where we're probably seeing some of our other process. And then to the point, we'll go through underwriting. So typically a process from any lender is kind of qualifying the lead, asking for a diligence list. Now, what I always say on our diligence list is there's probably 10 to 15 items on that diligence list. Early stage companies aren't going to have all 10 to 15 items. And so we always say, give us what you have, and then we'll kind of go from there. Well, biggest thing is, do you have historicals? If you've been generating revenue, do you have historical financials? And then what is your forecast? And then what's your assumptions and support for that forecast? And then if you've raised a series, A or seed, kind of seeing that cap table, seeing the term sheet. We typically go under NDA, so this information can be shared freely on both sides. And then let's say you get to, I would say a bank is typically underwriting within probably around 2 weeks, plus or minus, depending on how quickly the process is being ran. So 2 to 3 weeks to get to a term sheet. Now, our process is typically we're previewing with our internal credit, partly because we want to be able to move quickly after a signed term sheet. And also certainty, right? Once you pick a lender, you want to see that go from sign to close pretty efficiently. And so we'll be 2 to 3 weeks to term sheet. There's usually some back and forth on the term sheet. That'll take about a week. And then an underwrite. And so those underwrites will probably be another kind of 2 weeks. And then legal documentation. Um, we never kind of recommend legal counsel. All we typically say is make sure you have legal counsel that understands the venture debt market, right? And it might be different than venture equity, right? The equity, typically these firms handle both and handle both well. But having counsel who knows the market, it's not especially on the bank side, it's not you can't go to your local branch and get a venture debt. It's a very niche space in banking. And so because of that, it's a very niche law firm space as well. I mean, I won't do it here, but if anyone has questions on good counsel, there's a bunch of really good firms that also offer accelerator programs, right? Because they're trying to find companies that they can get their foot in the door and then grow with. And so a lot of really good connections there as well. Again, happy to make some intros if we connect off of after this call. Um, and then ongoing relationship management. Like I said earlier, this is where I think we do a very good job at Western Alliance differentiating and adding value is having the one-stop shop, right? To the point, I have a client from 2017. I'm still here, right? And so I'm no longer the day-to-day. I'm not the relationship manager. Those employees under us are strong and capable, but still involved, still communicate, still on calls, and it's important, I think, and why some of our clients stay for us as long as they do, is they get to know the people. Venture debt is very much a people um, business, right? If you think about we have VC connections, but on day to day, we are talking with management. And so it's a very important in that side of the relationship side that we feel we hear you and working with you. And so having dedicated resources and people on the same team, again, I think has shown, especially as, every 6 months, I feel like we have something new going on, right? COVID, tariffs, SaaS apocalypse, all these things, we're having consistency is super, super important. And so every time we see something like this pop up, we find we are adding that incremental value.
All right. So thank you, Brian. So yeah, for all the founders here on the call, we really like to stimulate some thinking as you think about how to position your company to grow forward. We feel it's very important for founders to have a relationship with a bank that can meet these needs of the company going into the future. So not all banks do participate in the venture debt product market. That's something that we do very well, and it all starts with building a relationship. As Brian mentioned, the relationship is very important with us. We really enjoy working with our founders early on, getting to know um, their team, getting to know the vision going forward, the go-to-market strategy. And one of the ways that our early stage founders can start a relationship with Western Alliance is through our startup banking program. So this is a curated curated program for companies that are not quite mature enough to reach the needs of venture debt, but want to have that ability to engage with us later on. Um, there's a couple things that we thought about, when building out this program, and the first thing is how do we uh, protect and minimize the burn rate of the company. So the first thing that we offer is complimentary and free banking services for 3 years or until a company does raise its Series A round. So that's the first thing we want to do. We want our founders focused on building, shipping product, developing and iterating and growing the team, not worrying about, how much it costs to send a wire transfer, things like that. So that's the first thing that we offer to our startup clients. And there's also additional services that a company might need later on. We have a full service FX team here that helps our founders with foreign exchange as a company grows its international reach and operations. We have the ability to really guide our founders on how to move money smartly into those international subsidiaries or paying vendors and contractors overseas. We bring that knowledge and service to guide our founders to make the best decisions possible. But we also do a lot of follow-ups and understanding with our founders on a quarterly basis at least, sometimes more frequently than that. And really what that is just to get a pulse check on the business, understand what's happening with the company, what are some of the near-term goals that you have, and also working with you to prepare you to engage with Brian and his team's process on the venture debt side. So we want to help groom our founders to be as fit as possible to qualify for deepening the relationship through venture debt. Rob, can we go to the next slide? Here we go. So this is what I was talking about in regards to our startup banking program. I would love to speak with any of the founders here on the call. If you are thinking about, starting a relationship with a bank that can become a capital provider to you at some point, our startup banking program is a great starting point for these early stage founders. So as I mentioned, the first thing is free banking for 3 years or until a company raises a Series A round. So there's no transaction fees, minimum balance fees, things like that. We just want our founders focused on building and growing. Next thing is a high yield money market rate to park any reserve funds. If you guys have received any grant funding or friends and family round or maybe a early seed stage investment, we want to give you guys a tool to park those funds and help extend the runway and have it grow. So that's our competitive interest rate you could see on the screen there. We also work closely with startups through our startup banking credit card offering. So this really helps the company to generate credit history and have a little more nimbleness with expenses and liquidity. So we do have a credit card offering that does help you establish credit history with the bank. So that way, once you do reach the next stage or Series A level, Brian and his team can kind of have a reflection point to look back on, how the company interacted with the credit card offering that we had in beforehand. And really, our goal is to become a connector to our clients. And as Rob said from the start of the call, we want to be more than just the bank that gives you a bank account and wishes you good luck. We're there with our clients every single day, advocates for you in the market. We want to understand, what helps you now, what helps you in the future, what type of doors can we unlock. I know we spend a lot of time talking about what we do on the tech and innovation side of the bank, but Western Alliance has a fund banking practice where we actively work and engage and lend to many of the VC and private equity funds here in the US. So we have those warm relationships with our VC partners and trying to work to make warm introductions to our strong, vetted startup founders is something that we aim to do, just to cross-pollinate both of the portfolios. So the relationship is really important to us. We want to be a partner across every stage of your startup journey and fill those needs across every single funding round that you might have. So if anybody does want to speak or just learn a little bit more, we're here to be a resource to you. We know that there's many options in the market, but our team has been doing this since the early 2000s. The bank knows this space very well, and we have a lot of strong success stories of companies that we've helped in the past. So really look forward to engaging with everyone here on the call. And if anyone has questions, Brian and I are here to answer those. So I think that kind of wraps it up, Rob and Ala. But we just thank everyone for their time and wishing everyone the most of success on their startup journey. And Brian and I, and along with our team, are here to be a resource to guide you.
All right, super cool. Thanks so much, Brian and Tony. We got one chat so far. And it's just a big thank you. So thank you for that. Um, I didn't say this earlier, but for anybody who would like to share your contact info with Brian and Tony through the chat, please do that. And they'll be happy to talk to you about your specific thing at some point. And you'll have a great conversation with them. I want to ask a question. What's the biggest or the couple of biggest things that that young companies typically trip on? What's the gotcha problem?
Um, Probably the biggest probably product market fit, right? The in the terms of technology, it is a very quick moving industry, right?
Can I stop you
Yeah.
right there, Brian? Because
Yeah.
we do tons of work around product market fit in our programs that we run here. I'm more interested in sort of the finance gotcha.
The the finance gotcha is probably gap recognition, revenue rec,
Really?
right? And that's where I kind of laid through it. Just being able to understand how the revenue model works, and also how it ties to runway, right? And so, especially like the difference between hitting that one contract, especially for an early stage company, could be the difference of 6 months of runway, right? And so we'll have companies that think they have 12 months of runway because of the confidence in that contract. Something happens to that underlying company, right? Budgets are getting cut here and there. And so where there was high degree confidence of, the corporate development person that they were going to sign this contract, that goes away once it makes its way up the chain and 6 months of runway evaporates, right? And so that's where probably we see the most pressure in the market. And again, it's not even just on the debt side, but for companies themselves, right? To really have your runway cut in half is hard to recover when there's people involved, right? Headcount and there's so much you can do sometimes to really be able to cut burn and manage to that. And so that's where there's value to that's probably going to be more an equity solution, right? When something like that happens versus debt. A lot of times we get calls for those kind of deals where a company has 3 to 4 months of runway because model is shifting. That is typically not going to be, definitely not for a bank. And then it would be just making sure who you're talking to on the credit side, the private credit side, make sure that you understand all the costs associated with that debt to take it on. Because it becomes pretty much like a bridge loan, which is a very different kind of instrument past
Sure,
growth capital
sure.
facilities.
All right, cool. We got a couple of things. Couple things in the chat and one question. So in the chat, we have Candace who left her contact info. Tony, can you see that?
Yes,
Okay,
I
so
did. Thank you,
you'll
Candace.
grab that. Perfect. And then the question from Son. Venture funds typically do not take on founder startup debt prior to a deal. Is Western Alliance Bank expecting investors to do so as a condition for recovering its funds?
Let me try to see if I understand that question. Venture funds typically do not take on founders' startup debt prior to a deal. Um, so if I'm reading this question right, how do we typically get paid back? It's
That's the way I
typically a
interpret
liquidity,
also.
yeah. It's typically a liquidity event, right? And so I would say 90% of the time, we're break to the point we're going to the next round. We're to the point, the other point I made, we're modifying the loan. We're typically resetting the clock, right? You have now new equity going onto the balance sheet that's extended runway. The facility typically is then being modified to extend runway again, reset the interest only period, increase the loan to fund, right? And where there is, I think, to the question where there's sometimes a disconnect is on the loans where it's perhaps not enough equity is going into the business to extend runway at execution. Is this the term you'll hear is drip feeding? Is the company is equity drip feeding versus capitalizing the business to execute on the top line? That's where you'll see typically misalignment on debt and equity in those situations. And that goes back to everyone having to get to a compromise in those specific situations, right? Management, where it might be reducing burn in some ways, the bank making some modification that is needed to be made for the funds to bring in money. And then, but sometimes also is a fund trying to get them not to drip feed, right? Actually provide enough capital for extension to execute on, right? And that goes back to the point of having the point of contact being consistent from underwrite to portfolio, because that happens a lot, right? Those are conversations. They're not great conversations to have. No one is enjoying those. Again, it's a compromising right? You're having to mediate someone between groups, right? You might have sometimes like there's so many different scenarios, but sometimes, right? Equity wants to put it in, but management doesn't want the dilution. But again, you're talking about the time clock, right? Sometimes you'll lose some of that leverage in the downside scenarios when you have debt in place. Um, and so again, over communicating is also very important between all parties in those downside situations. Um, it's to the point, hey, instead of when you're telling your bank you have 12 months and then tomorrow it's 6 months, right? That's tough. That's a tough situation for both your investors and your bank. So being able to know plan A, plan B, C is very important. But I would say 99% of the time we're coming out on a liquidity event, right? A strategic's buying, um, a PE's coming in and recapping the business and either we we have a sponsor practice that sometimes provides debt in those scenarios, or they might be coming in with, a private credit lender for higher leverage, right? Like some of the ones you're hearing in the market today. But I would say most of the time we're extending our deals in those scenarios until they're a strategic come in and they don't want debt on the business.
Cool, cool. Yeah, there's a lot to peel apart there. We've got just a couple minutes left, and we do have one more legit, not that these aren't legit, but one question in the Q&A place in Zoom. That in my world, that makes it legit. Whatever, that's not fair. So I'm sorry about that. What is the best time point to hire a finance person if you're in your team, if you are a startup and all your team is technical?
It's a great question. I always, my first answer is talk with your board, right? Your board should be providing this guidance, right? We, as a lender, will have opinions, but always rely on your board in those conversations. Where we typically see it is pretty much around that A round, right? Um, for companies, if you really think you're going to go from $1 million in revenue to 6 million, 7 million that year, you probably need a CFO, right? Because what you also start getting into as you start scaling kind of above that 5 million is you're seeing these growth investors who typically were doing $20 million revenue deals are coming down market to kind of look at $10 million revenue deals, right? Because they're looking for high quality assets they can deploy capital in. And so they're going to come in with a mindset of gap revenue is very important, right? Potentially even you'll start seeing around $10 million in revenue, the need for an audit. Once you have investors asking you for an audit, you need at least a VP of finance, maybe even a CFO. That's a burden you as someone who's executing on a plan do not want to take on. But yeah, for the most part, we're seeing it kind of around the A, right? Either right after or right before. There are some really quality fractional CFOs out there as well that we're seeing kind of in between those places that help you just kind of take it off your plate. They're finding a lot of good places out. They can outsource it, so they're cost effective. We're seeing, you know, uh, we remiss if we do not bring up AI. AI is starting to really figure out how to get financials in a clean place, we're seeing. And so we're probably, my guess is like 6 to 12 months away from really seeing that be a huge differentiator for accounting purposes, right?
A robot CFO.
Yeah, some kind of but like I mean, we've been talking about bots on the account on an accounting side for probably 5, 6 years, but now you're really seeing how clean it can be. Um, and so TBD on that, right? We're trying to figure out at our bank if we can start really pushing a lot of our day-to-day Excel modeling and into AI. We're seeing some early promise around that. So yeah, that'd be kind of my feel. But again, make sure you talk to your board too. They're really who I'd lean on for those kind of
Awesome.
discussions.
So we're right at the top of the hour. So with that in mind, I'm going to say thank you to all of our attendees as they start to trickle out. I'm going to stop the recording. Harder than you would think.